friends, such a delight for me to welcome each one of you to this IMC MCX webinar. We call this Commodity Fundamental Forum, and in this forum today we are going to discuss base metals. I must mention IMC Chamber of Commerce and Industry is a 114-year-old Chamber of Commerce. It's a legendary institution headquartered in Mumbai, and we have joined hands with MCX India. MCX is one of India's largest commodity derivatives exchange and one of the largest in the world. And MCX specializes, of course, in metals and in energy. Plus, they also have some agriculture products. And MCX is obviously the leader in the commodity derivative space. And it's such a delight for us at IMC to join hands with MCX. And we, over the last 5 years or so, we have done numerous events. And this Commodity Fundamental Forum is something which is ongoing. From time to time, we cover agriculture commodities, energy products, precious metals, base metals. Today, of course, we are going to be discussing base metals. Anita, is there a disclaimer that has been mandated? Would you like to show? Okay, this is a disclaimer which we have to show. Allow it to stay for about 10 seconds at least. And this is mandated by SEBI. And of course, this quiz is safe. Okay, all right. I must allow me a few seconds to share screen. I am going to make a presentation. I'll speak for about 15 minutes, I guess. And we have Mr. Prithvi Jain from ASMA, but he still hasn't joined. I hope he would join. And of course, then after that, I'll invite Kunal and Kunal Shah, and then I'll invite Chittaranjan Rege from MCF. So allow me a few seconds to share screen. Here it goes. Slideshow. Okay, all right. MCX IMC webinar on Commodity Fundamentals Forum base metals. I'm going to be talking about outlook for base metals in the second half of the year. Because an exchange is involved in this, we shall not discuss specific price outlook. We'll only discuss possibly market direction, what is outlook for the base metals in the second half of the year, not give any price forecast or price outlook. I must also mention that IMC is a SEBI accredited training institution for commodity derivatives. The SEBI has recognized about a little over 20 institutions across India as training institutions for commodity derivatives. Almost all of them are actually educational institutions. IMC is the only chamber of commerce in the country that has a distinction of an accreditation with recognition from SEBI as a training institution for commodity derivatives. And in this capacity, we do a very large number of events to promote and to help widen and deepen the commodity derivatives market. Allow me to go to the first slide. Okay. Let me talk about a VUCA world. All of us are by now familiar with this word VUCA. And everybody talks about VUCA. And what is it? Volatility, uncertainty, complexity, and ambiguity. This is what exactly characterizes the market now. And of course, this is what has been happening over the last 2 years, 2020 and 2021. And we all know, and of course, in the first half of 2022, and we know because we have lived through these times, we know what exactly happened in 2020, how there was a massive demand destruction as a result of a national lockdown across the world and disruption to shipping, etc., etc. And therefore that is continuing. We had the pandemic. Of course, the pandemic was preceded by a trade war between the US and China, if you all remember, 2018 and 2019. And we, of course, now have a military war, a real war between Russia and Ukraine. Then, as a result of which, the world has seen sanctions. First, sanctions against Iran, and now, of course, we have sanctions against Russia. We have seen protectionism, and a lot of countries are protecting their export or their natural resources. There is a tendency to reduce import dependence. There is a tendency to even curb exports by imposition of export protection, export curbs, export controls, etc. So protectionism is the in thing these days. Then you have massive supply disruption. We have seen in the last 2 years extraordinary supply disruption, particularly through the sea route, and how freight rates have multiplied manifold. Plus, now we are talking about resource crunch, particularly of energy products as a result of Russia-Ukraine war. And Europe seems to be very highly vulnerable to this energy crunch. I think that's all this is combined to create a massive amount of.
Sir, will you please share it again?
That's what I'm doing. Yeah. All this is creating a massive amount of uncertainty and volatility in the commodity markets around the world. And therefore, there are several market drivers. I'll talk about those market drivers in the next slide. But these market drivers are all, who's changing this? Why? I don't want any disturbance. The market drivers are all morphing. They're changing all the time, and that makes prediction or forecast so very difficult, increasingly difficult. And this uncertainty and this rapid morphing of the market drivers actually heightens the risk and, of course, the risk perception in the market. And that makes management of price risk extremely critical for those value chain participants and investors in the commodity market. And because we live in a VUCA world, because there is huge price volatility and uncertainty about market outlook, I think it's extremely important for market participants to have an informed outlook about the market, a well-researched outlook about the market. And the purpose of today's seminar is to provide market participants, of this seminar, informed market outlook, especially on base metals. Now, this is my favorite slide. I've been showing this for ages, and this stays all the time. I will look at these 6 drivers of the global commodity markets are operating simultaneously at this point of time. There's a strong positive correlation between economic growth and consumption. Commodities are called growth commodities. For example, in the base metal, copper is called a growth commodity. As economic growth picks up, consumption of copper, demand for copper also picks up. Energy products, crude oil is also called a growth commodity. As economic growth picks up, demand for crude oil goes up, etc. Therefore, we need to be tracking economic growth, whether growth is accelerating or growth is slowing, in order to get an informed view about commodity demand. Okay. The second one is geopolitics. Geopolitics actually refers to a war-like situation or political instability which we are facing around the world around today. and geopolitical instabilities immediately impact commodity markets, especially the energy markets, because there is always a risk of disruption of supplies. And at the moment, we know the Russia-Ukraine war is certainly disrupting supplies of energy products from Russia, and Europe is very highly vulnerable to that disruption. Crude oil prices have gone to 3 digits. Natural gas prices have gone up. Coal prices have reached unprecedented levels, etc. And therefore, geopolitics is also is exerting its influence and its impact on the commodity market, particularly base metals. And as energy costs go up, the cost of production of base metals actually goes up, and therefore geopolitics is important. Energy prices are important for the base metal sector. Monetary policy. More money available, the prices would tend to go up, which is what we found in 2020 and 2021. The many countries, primarily led by the United States through the Federal Reserve, they had ultra accommodative monetary policies, and they dropped interest rates to near zero levels. And this ultra accommodative monetary policy, huge liquidity at near zero interest rates, actually a lot of this money got invested in a number of assets, including, of course, commodity markets, commodity assets, and of course in the stock market. Now that the ultra accommodative policy is being unwound, interest rates are going up, and in fact now there is not a monetary easing, a quantitative easing, but now there is quantitative tightening, really speaking, and that's on the commodity markets. Currency, of course, we all know how low the dollar went in 2020 and how it has started to pick up in 2021 and how strong it has become. And therefore, the strength of the dollar obviously exerts a certain influence on commodity prices. The commodities that trade in dollar terms, when the dollar becomes strong, which it is currently, obviously it caps the upside for commodities. Weather is again a critical driver. It may not be so critical for base metals, but certainly weather is critical for agriculture commodities. The world faced 2 successive years of La Nina, which affected crops in particularly in South America, and that's why we find prices have gone up of soybean and corn, etc., etc. The funds have played a major role. The ultra accommodative monetary policy created so much liquidity that we found huge investment funds flow into various commodities, and that also accelerated the price rise in the commodity markets. And very surprisingly, we also found in the last 2 years massive supply disruption. The supply disruption does not happen. It's actually a very rare event, but it has happened in the last 2 years, and it is likely to continue this year also, and therefore that's also resulting in pockets of surplus and pockets of deficit, which creates uncertainty in the marketplace, especially commodity. Therefore, we need to be those in the commodity markets, either as a value chain participants or as an investor, need to track these developments to get a fairly good idea about where markets are going.
Sir, excuse me.
Yeah.
Sir, you're still on the VUCA world slide. The slide is not moving.
Oh, it's not moving. Okay, let me. It's moving in my. It's moving.
Sir, stop the show and again do the slideshow.
Yeah, exactly. Where is it? How do I? No, I can't. How do I stop this? I don't have anything.
It's already stopped. It's already stopped. Now just share it.
Okay. Have we? Okay. Is it moving?
So you haven't shared it as yet.
All right, right, Ma. Thanks. Thanks. I appreciate
Welcome.
appreciate this. Okay, all right. Now we're going to the next slide, right? Yeah, okay. Okay, I think we have done this with this slide. I'll go to the next one. Let me give you a sense of how base metal prices have moved in the last 4 years.
Sir, it's not moved, sir.
But
You're still on the VUCA
no,
world
no, I
slide.
agree. But in my I have to stop share. Okay,
Yeah.
I stop share. Now I'll share again.
Share again
I'll
and
share
run the
again.
slideshow again.
Let's share 1 second. Sorry. Yeah.
Just a minute.
Is it gone? Yeah.
Yes.
Is it a new slide? Okay. Let me go to the previous one and tell. I'm sure participants will know. Economic growth, geopolitics, monetary policy, currency, weather, and funds are the 6 key drivers of commodity markets. And in fact, any asset market for that matter. And now, in case of commodities, we have an additional driver, which is the supply disruption. All right. Now let's look at how base metal prices have moved in the last 2 years. All of 2019, these are all end June prices of the last 4 years. I've shown 2019 because 2020 was an extraordinary year. Massive demand destruction, lockdown of various countries across the world, and because of collapse of demand, prices crashed, and therefore that I want to show that comparison. 2021, obviously, there was a kind of a revival, and the confidence returned to the market because of large-scale vaccination, etc. And in 2022, prices have spiked primarily because of the war situation, and therefore the confidence coming back to the market as far as growth is concerned. But what is the latest is a fear of recession. Okay, these are indicative prices for end June of the last 4 years, and you can see how volatile, for example, copper prices have been, how zinc prices have moved, and how aluminium prices have spiked in the last 2 years, etc. I think this is only to give you a sense of the kind of VUCA world that we are living in, and how base metals are affected. Let's go. Where do we go from here? That's a big question. Now, there are several impact factors that we saw earlier. There is a combination of all these impact factors. Economic growth, growth prospects and the fear of recession is present at the moment. Geopolitical instabilities are present at the moment. Monetary policy from a tightening perspective is present at the moment. Currency, strengthening of the dollar, weakening of the rupee, obviously is another factor affecting. Weather is, of course, much less to do with the base metals, but fund play. Funds are all possibly slowly exiting commodity market. Therefore, all this factors are working simultaneously. The ongoing Russia-Ukraine war and high energy prices, tightening liquidity, and rate hike. And now, of course, we have inflation. The US is facing 8.5% inflation, highest in the last 40 years. And of course, growth is slowing and fear of recession. For all these impact factors have combined to exert a certain influence on the global base metals market. China, we cannot forget China. China is, after all, the mover and shaker of the global metals market, the base metals market, and China is beginning to has already started to slow down. There is one forecast which says China's GDP growth in 2022 could be as low as 4%. For a country that was growing at 10, 11, 12%, and of course it was sliding in the last few years, and until 2 years ago it was at 6 to 6.5%. 2022 is likely to be 4% is a forecast. And if as they say, if China sneezes, the world market catches cold, at least as far as commodities are concerned. But China factor is something which is playing out in our metals market, industrial metals and base metals market. Therefore, in the near term, in my view, there is a tug of war between bullish factors and bearish factors. Now, high energy costs plus low inventory of metals in exchanges like the LME on the one hand is having a tug of war with weak demand growth and risk aversion of investors. Investors are slowly exiting, primarily because of the tightening of liquidity and very sharp increase in the interest rate and the prospect of further increase in interest rate in the second half of the year, and the risk of a weakening demand growth. And therefore, that's a tug of war which the market is currently facing. And therefore, my sense, when we put all this together, there is a strong possibility that the base metals market may fall from the current levels. Okay, but don't expect a price collapse. I think we are nowhere near a price collapse, but the current levels of prices, they seem to my mind to be somewhat unsustainable given the current factors, and therefore there could potentially be a correction in the second half of the year. Now there could be a wild card. There are now people are speculating primarily, but obviously even that speculation probably has a basis. There is now expectation that that Chinese economic growth, which is slowing down, can possibly rebound by the last quarter of this year. And if signals for that rebound are available in probably in the coming quarter, July, August, September, then possibly even that correction that we are talking about may be moderated. This is possible, but we don't know. It's China. China's growth is still a wild card. As of now, Chinese growth is forecast at, GDP growth is forecast at 4% for 2022. Okay, now very specifically coming to specific base metals, let's talk about copper. The International Copper Study Group says that the market was oversupplied in the first half of this year. And refined copper supply has been rising, it exceeds demand, and therefore there is now a view that the outlook for copper is somewhat bleak because of demand concerns and the fear of recession, and of course the risk appetite amongst investors is poor, and that is why we found prices have corrected closer to $8,400 a ton from much higher levels this time last year. The International Nickel Study Group says very clearly that global supply has grown twice as sharply as demand. The supplies have grown far above or twice as much as demand, and therefore the market is still showing. Last year there was a supply deficit of nickel of about 64,000 tons. This year, despite the fact that supplies have grown much faster than demand, there is a moderate supply deficit of about 8,000 tons. Obviously, the market participants will bear this fact in mind. The International Lead and Zinc Study Group is talking about tightening supplies of zinc, tightening market for zinc. The market seems to be undersupplied to the extent of about 13,000 tons. There was a surplus last year of zinc, but this year it appears to be undersupplied, and LME zinc stocks are of course quite low. And in case of lead, the global market's supply exceeded demand by a certain quantity, which is same as last year, and therefore that obviously will have to be we need to take all this on board. But these are the specifics of copper, nickel, zinc, and lead. And I'm sure I have other expert panelists who will take this thought forward. So I will stop here. I have used my, I guess, 15 or 20 minutes time. I want to thank all my co-panelists and all the participants. I have to issue a disclaimer, which I do all the time. I am not a trader. I don't trade commodities. I don't hold any position in either in the physical market or in the futures market. I'm a student of this market. I'm also a teacher of this market. I teach commodity market. And therefore, with this, let me say good luck. God bless you all. And invite, is Mr. Prithvi Jain, has he joined, Anita?
No.
Not yet, okay. Then I'll invite our friend Kunal Shah. Kunal needs no introduction. You can always see him on television. He's there in every what should I say, commodity conference. A very enthusiastic, exuberant person. I'm sure he has deep insights and very knowledgeable. Kunal, the floor is yours. Please share your thoughts on the outlook for base metals in the second half of 2022.
Yeah, so thanks a lot, sir, for giving me this opportunity. Thanks a lot, IMC. It's my pleasure to be a part of this panel and throw some light on what is going to be the outlook on metals going forward. So like Mr. Chandrasekhar said, we are not supposed to give the price outlook, but we are basically going to give you a directional view during the second half, what is going to happen, what is likely to happen. So these are the times, as a fundamental analyst, we find very difficult, to get the data itself to substantiate anything. So after COVID-19, to get the numbers, it has become very difficult task. What it used to be earlier, very easy now to get the numbers. So you try to collate the numbers, but I think the bigger picture here is not about the demand and supply. We have to understand it's a very different world right now. Whatever is happening in global economies right now, it is beyond a normal traditional economics. So we are in a very different time right now, a sort of scenario where the Cold War started. We are in a similar situation where a lot of economies want to regain the power. They want to shift the power. They want the US. They want themselves to be superpower. They want to throw away the dollar dominance, use their own currency. So geopolitical tensions have started in last 6 months and they are aggravating. And amidst all these things, what is going to be the outlook? And that is very challenging. So I'll try to be very clear on my view, and let's start. So our theme is waning influence, inflation. So what we mean by waning influence? So going forward, the inflation, which is very sticky, will peak out sometime and it will start to go down. So after 2008 financial crisis, we've seen the unconventional monetary policies, and especially during last 2 to 3 years, we have seen a different kind of monetary policies adopted in order to battle deflation at the time of COVID. So just to avoid the deflation, US, Europe, and Japan cumulatively printed roughly around $7.5 trillion, $8 trillion. So the magnitude of this money, if you see, that is inflated everything. All assets are inflated because of that. Maybe real estate, maybe stocks, maybe commodities, each and every asset, including Bitcoin, everything was inflated. Now, at the time when US, Europe, and Japan were easing like there is no tomorrow, UK, China was deleveraging. So in 2020-21, China has deleveraged. They were not easing at the time. US and other Western economies are easing. And now, because of the inflation, US, Europe, and each of these developed economies are doing tightening, and China is doing easing. So it seems that China the policies of China and Russia and all these communist countries, they are easing at the time when the inflation is very high across the globe in the different parts of the world, not at their economy. In China, the inflation is not high, but in other part of the world, the inflation is very high. So at that time, they are trying to do easing. So it's a completely different world right now. So many factors are playing right now, and out of that, we have to see which are the factors which is going to determine the outlook of metals. So the major problem, for the world is the energy crisis. So because of the COVID-19 crisis, we have seen OPEC cutting production as high as 8.5 million, 9 million barrels per day, and then gradually started to increase the production from October 2021. They started to implement 4 lakh barrels production hike from that onwards. This compliance so far is not being made. The refining capacity across the world for crude oil has gone down in last 2 years, including in US, Europe, each and every part of the world. The refining capacity has gone down, and the other energy, the other prices of other energies like natural gas, coal, due to the geopolitical tensions, we have seen sharp up move in the prices of gas. We have seen sharp up move in the prices of coal. So energy is the key component which is driving the inflation across the world. So if you see here in chart, in US, more than 40% of the inflation is contributed by energy. So till in Europe, more than 65-70% of the inflation is because of the energy. Then comes the labor inflation, then comes the agriculture commodity inflation. So the question is whether the oil will go down or not. The fundamentals of oil, it's very important in the context of base metal to understand the fundamentals of energy. The fundamentals of energy are not bearish because of the Europe has banned the Russian embargo, Russian oil imports. Russia's oil production is going to decline from 1.5 million barrels, which is dropped in last 6 months. Now, in next 3 to 4 months, it will decline to 2.5-3 million barrels, from 1.5 million barrels to 3 to 3.5 million barrels. So the world will require another 1.5-2 million barrels of oil. So if the Saudi and UAE and the other oil producers like US, they increase their production significantly, then energy prices, oil prices can go down, but the fundamentals are not bearish for oil. So it seems that going forward, energy can be a big challenge in order to bring down the inflation. So now if you see what has happened in 2021, so I'm talking about top 4 to 5 economies, developed economies, and China in emerging market. US GDP 2021 5.7% real GDP, Europe 5.3, UK 7.4. Now US GDP is going to be reduced from 5.7 to 2.66 this year. So almost 45% drop in GDP growth in US. Europe same, UK same, China like Chandrasekhar ji said from 8% to 4%, Japan from 1.7 to 1.5%. So just think that if the growth is faltering, the demand side of the metals, how it is going to be strengthening, how we are going to see metals outperforming and rallying from here if the growth is really getting affected. So my first concern here, if this monetary tightening and this policy remains, the growth is going to get affected, and more than supply concerns, in next 3 to 6 months, the demand concerns will start coming out. So because of the tighter monetary policy conditions, the demand growth of all these metals are going to remain muted. Then the second part, inflation. In US, average inflation last year was 4.7, this year it is 7.9. Europe 4.6 last year, this year 7.7. UK 2.6, this year 8.3. So China from 0.9 to 2%. So apart from China, everywhere the inflation is high. So in context of metal, China still has a room to further do monetary easing, further introduce stimulus package in their economy to revive the growth, which is faltering right now. So you can expect in coming days, China to come up with the more stimulus package, more easy monetary policy in order to revive their troubled housing sector, in order to revive their economy after COVID restrictions, what they had last 2.5, 3 months. Their growth has fallen quite sharply. So on one side, you have to keep this in mind. One side, Chinese are going to come up with the easing measure, which is supportive for metals. But what is not supportive for metals is the balance sheet of these Western central banks. So this is the chart I would like to really want everyone to focus on. So see, once the COVID crisis started, this arrow, the balance sheet of US expanded from $4 trillion to almost $9 trillion. Okay. So what do you mean by balance sheet expansion? The balance sheet expansion is simple. When the government prints the bond and gives that bond to the central banks, and central banks take that bond on their balance sheet and releases the liquidity in the market. So $4 trillion of liquidity, $4.5 trillion of liquidity have been infused in last 2 years. Now, in order to curb the inflation, they are sucking this liquidity. So every month, they are going to reduce their balance sheet by $90 billion, $95 billion. I'm talking about US. Similarly, Europe in next 2 months will start shrinking their balance sheet. So on one hand, no matter what China does with their monetary policy, the liquidity, which was the friend of commodities in last 2 years, is no longer going to remain friend. Liquidity conditions are going to be tighter. The interest rate in US have moved up from 0 to almost 175. And next, by the end of the year, it is likely to test 2.75 to 3%. So the cost of borrowing money is going to be expensive. And at the same time, the liquidity, the bond which is there on the balance sheet of Federal Reserve, on the balance sheet of European central banks, they are going to sell these bonds in market. So the liquidity from the market is going to get sucked out. So irrespective of Russia being largest producer, one of the largest producer of aluminum, producing copper, we've seen so much supply tightness. Most of the metals are down by 20-25%. Some of them are down by 28-30%. So what is the use of demand and supply right now when the liquidity conditions are getting tighter and tighter and tighter and tighter? So demand and supply right now doesn't matter to that much, because the froth of liquidity, this copper at the start of 2020 was what? It made a low of $3,500. It was trading at $6,500, $7,000. It has tested $10,500, $11,000. And from now, 11,000, we are down to $8,500. So we've just seen some correction. We are still, if these liquidities are going to get out from the market, we are going to see much pain for the metals, the construction sector across the globe, the housing sector. The demand is going to go down going forward. So I think between the two factors, China coming up with stimulus can cause some spike in the prices of metals. But those spikes are not going to be sustainable, because the liquidity conditions will get tighter and tighter and tighter and tighter going forward. So this is what the main theme of my presentation. More than the demand and supply, you have to understand the macro call. Now, like I said, China is having its own problem. Their industrial profits are down, their fixed asset investment are down, their manufacturing PMIs are down, and that's why the government is coming up with stimulus package. Is going to come up. They've already done the easing so far, and they are going to do more easing going forward. And hence, we believe that some pullback in the prices can be observed. So now we'll start into the metal. We'll start focusing on each individual metals. So copper last year if you see the demand and supply, total mine production was 21.32 million tons. Global refined production was 25 and consumption was 25. So we had a balanced market. This year, we are expecting the consumption to slightly pick up from 25 to 25.8, but the market is still not in a major deficit, which can cause sharp rally in prices of copper. So we are expecting smaller built-up in the surplus. So you cannot just compare prices with the exchange inventory. The inventory in exchange can remain low, but that doesn't mean that the fundamentals are very tight because of the lower exchange inventories. The exchange inventories are very small proportion of the overall total market. We are talking about a market of 27-28 million ton. So if the inventories were so low in Shanghai and LME, the copper prices should have been $12,000. That doesn't work that way. So another thing, the consumption was marginally high, is expected to grow by 2.8% growth in 2022. Going forward in 2023, also we are not expecting any major upside in demand growth. So relatively muted growth. If you see copper imports have declined of refined copper in China because the production in domestic market has improved. The scrap imports have picked up in China. The treatment and refining charges have come down, better availability in the spot market. And if you see the futuristic demand of copper looks very, 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 very bright, especially from the EV sector. So copper content per vehicle, if you see hybrid, BEV and e-bus, so the amount of copper required per vehicle is going to go up quite significantly. So I think going forward, the demand of copper from the new usage is going to go up significantly as compared to the old traditional use. So this is one silver lining as far as the demand side is concerned. So we had a view that, yeah.
He was preparing for the meetings.
Hello. Sorry.
You can carry on. You can
Yeah.
carry on, please.
So my view on copper is not from the price point of view. There can be some pullback because of the Chinese stimulus, but the broader view doesn't look very lucrative because of the monetary tightening. Aluminum is the most interesting metal in the entire base metal complex. We started a year, I deliberately kept this slide to show you this was what was expected by the consensus across the globe. We started the year with the expectation that the Chinese production of aluminum will drop by 8 to 10%, and hence aluminum market will be in major deficit. So for the first 3 to 4 months, the Chinese production remained tight, but then they started to produce because of the higher prices. When prices tested $3,800, $3,900 after Russia's invasion of Ukraine, the production, Chinese smelters started to ramp up the production, and from last 2 months, China is producing record aluminum. So the entire equation, because of the higher prices, have changed in aluminum. So once upon a time, which was considered to be the safe haven of the base metals, has turned out to be one of the worst performing metal of the year so far. So global aluminum supply rose to record. So everyone was saying at the start of the year that we are going to see production cut, but so far it is not going to. And 2022, the supply of aluminum will be 69.2 million ton as compared to the last year's 67.34 million tons. Forget about all those stories of power crisis, higher power costs causing aluminum to go up. All these stories are off market. And now we are living with the story of the higher production from China. So at any point, even when we started the year, there was no evidence that the production of aluminum is going down in China. They were saying that they are going to do the production cut. If you see this chart, the 2022 overall, there is going to be an expectation of 10 to 14% demand growth in aluminum production. So forget about the story of the emission, clean energy, and that is going to bring down the aluminum production. All those stories, because so this is the nature of metals and commodity. When prices are so high, the average cost of production for aluminum was 2,500, 2,400, and suddenly that material is being available. The prices of that aluminum is at 3,800, 3,900. All producers started to aggressively produce aluminum. So outlook still not very bullish. And again, I'm saying, you know, a sell on it's a sell on rise. You can expect a 5 to 6% upside in near term, but it is not looking attractive to me at all going forward. This is my view for all metals. So 4 to 5% upside can come because of the China stimulus, but broader outlook. Now zinc, very interesting story. Zinc prices rose because of the energy crisis in Europe. So major European smelters started to basically cut down the production of zinc. The mines, the smelting operations were halted, and because of that, zinc prices rose. But in spite of all those production cuts, even zinc prices corrected. So this is my point. It is no longer about the demand supply side problems in the commodity in metals market. It is about the tighter liquidity conditions are going to cut down the demand going forward 2 to 3 months down the line, the demand growth. So people have started to even talk about the recessionary concerns at the end of the year in US because of the tightening. So even zinc, aluminum, lead, all these metal doesn't look attractive to me. And I am of the view that this is just a start. The pullback, there can be pullback, there can be some bounce back, but these prices are not going to go up. We are going to see new lows being made during the year 2022. And once we get a hint from Federal Reserve that they are going to stop the quantitative tightening, the QT, the word, they are going to stop selling those bonds in the market. They are going to stop doing the reduction of bonds from their balance sheet. That will be the trigger for metals to really start moving. So I think 2023 can be a good news. 2022, it's going to be a sell on rise bear market for base metals. I hope I have provided value to all the listeners. Thank you very much.
Thank you, Kunal. I think this was wonderful, extremely well-researched presentation. Thanks for sharing. I agree with you. I think there is no, as of now, no significant upside for base metals complex, but there can possibly be a small, in the short term, a downside. And I agree with you. What would the Fed do next year? Because there is a risk of recession in the first quarter of 2023. There is now an emerging possibility that while the Fed will continue to raise interest rate till the end of this year, once a recession hits the US in the first quarter of 23, probably in the second or third quarter, it is possible the Fed will start to drop the rates. And that scenario is very clearly emerging at this point of time. So it's a very interesting interplay of economic growth, geopolitics, energy prices, monetary policy, currency factors, and of course the fund play eventually. So I think awesome. Thank you very much, Kunal. We don't expect anything less from you. Okay. Thank you very much, and I'm sure participants have had good value, and there are some participants now demanding your presentation. So you better post your email ID and share it with them. I'm now going to call Chittaranjan to share MCX's perspective. As we all know, MCX is India's largest commodity derivatives exchange, and it obviously specializes in metals and in energy. And Chittaranjan heads the industrial metals and base metals section in MCX. And let us hear Chittaranjan's view about the exchange's view on the outlook for base metals in the second half of the year. And Chittaranjan, please share with the participant what should they do to manage the price risk and to address the volatility in metals market. The floor is yours.
Thank you, sir. Thanks. Thanks a lot. What I really like about Kunal's presentation is, it has given us a hope that the prices will come down. All right, that's one. But I mean, is that the reality? Because the audience who has gathered here today, our value proposition, or not to undermine what Kunal has given, because the perspective of what may happen in future is very important. But what we really think, from the exchange, practically we get to meet and speak and do VC with plenty of people all the way, throughout the year. And I can tell you, sir, every alternate person I meet has a contra view. I mean, half of them are thinking it's probably going up, half of them thinking, and all those who are thinking that the probability is going down are worried that if the rupee depreciates, then the overall impact in their books is going to be the same, and so on and so forth. So, I mean, to cut the long story short, my assessment or the exchange perspective in this is whatever may happen globally, at the end, you need to be operating and doing business locally. And in the local perspective or the domestic perspective or the national, the price discovery perspective, I think there is an excellent platform which we have created. Now, when I say excellent, I mean, there is a reason and the purpose as to why we believe, it is so. So briefly, a journey of what has happened in last 3 to 4 years in particular. So we all know that the MCX has, the contracts which are, for the metal contracts, and aluminum, copper, lead, nickel, and zinc. So story doesn't end there. What has typically, or I mean, which is more important to note, that in last 3 years, we have converted the contracts to a delivery settle, and the prices what we depict on our screens now are essentially the India-centric prices, and more so. So what I believe is that the audience who has gathered here should go back with a lot of clues what Chandrasekhar Sahab and Kunal have given, and at the same time, you should go back with a lot of hope to be able to manage your margins pretty well if you adopt to the mechanism what MCX offers. Because at the end of the day, whether prices go up, whether the prices go down, whether the prices remain, I would say, trading sideways, in every scenario, it is most important to remain, profitable, keeping the businesses alive, keeping the margins intact. And all of that is possible when you actually take or subscribe to a financial, hedge instrument which can allow you to do so. And we believe that, now that for the consumers or the industrial, product or the metal consumers, there is a viable platform now available. So I think you should all look at very carefully subscribing to the hedging mechanism. We trade. The exchange terminals operate right from morning 9 a.m. till evening 11:30, and on Monday to Friday. So there is, no matter what is happening to the global scenario or the currencies or whatever throughout the day, all of that get captured on what's happening on this thing. So I have a brief presentation which let me share the screen. I hope everybody is able to see it now.
No, that is mine.
Is the screen and the
Yes, we can see it now.
Okay, yeah.
right? So what we the message what we want to give to the audience is that there is a way in which you can manage price risk. And not only that, there are extended solutions in terms of delivery-based solutions. So with a clear perspective to focus on aluminum, copper, lead, nickel, and zinc, here is the value proposition what MCX has. So not to spend too much amount of this, but we've been operational since November 2003, and we have got all segments, so bullion, industrial metals, energy, agri, all of that listed. And the metals vertical does a sizable business in the entire thing, but what's numerically explainable is something like this. So on an average, if you see in terms of the first three, I would not say the first one column gives you the details of the metal, but corresponding the subsequent three are giving you how has been the metal performance in terms of average value what we trade each day, and then the subsequent three is giving you in the quantity terms, and finally the open interest. But why don't we look at these figures where the cursor is right now? So on an average on aluminum we transact close to about 20 to 25,000 tons of metal, on copper close to about 25,000 again, lead close to about 7,000. Nickel has seen an aberration, so right now it's struggling, but I'm sure we will get our act together and we'll be back in action there as well. Zinc again about 25 to 26,000 tons. So this much quantity gets transacted each day on the exchanges. So these are delivery based models, GST compliant, and so how does the industry can use it? So let's start with the basics, that the quality specifications of whatever we have listed are very acceptable commercial grades. So on aluminum, it's a primary aluminum with a minimum purity of 99.7. The three shapes which get delivered are ingots, sows, and T-bars. Copper is all grade A copper cathodes only. Lead is 3-4 grades, so with minimum purity of 99.97. We have now introduced our own grade, which is 99.98, and under that we are recognizing the the brands, domestic brands as well. Then there is 99.985 and 99.99, which is Hindustan Zinc grade, and 99.9943, which is, which comes to India very rarely. But the point is that despite of all of these grades, and all the LME registered brands under that can get delivered on MCX. On nickel, it is again primary nickel with 99.8% purity, and zinc, which is special high grade, which is 99.995% purity. So, Hindustan Zinc is the only one who is producing here in India. The reason we put it across is like this, that when you transact on MCX, you basically don't have to really doubt that when your price discovery of the product which is listed there, or what you're seeing on screen, is when it comes to lead, minimum purity of 99.97 is guaranteed. With nickel, it is going to be uncut cathodes, which is minimum purity 99.8. And for zinc, it is going to be special high grade ingots only. On aluminum, 99.7. So this is given in terms of what we transact and what we trade. Further details on each, the trading lots are 5 tons for aluminum, zinc, and lead. Copper is 2.5 tons, nickel is 1.5 tons. We have got monthly contracts, which means every month. So, right now, 5 months contract with June is trading, July, August, September, October are trading. Last working day of the month, which is why we call it monthly. Last working day of the month is when the expiry for all happen. Uniformly, they all expire at 5 o'clock for that particular month. Rest continues till 11:30. So the price code, what you see on screen, in addition to the shapes and the purity, what I have already told you, for aluminum, it is going to be X Raipur price, which is at Chhattisgarh. For copper, zinc, and nickel, it is going to be X Thane, which is Thane district, is where the primary delivery centers are, and for lead, it is Chennai. But what has happened now is, I have a slide on it, so probably I will explain you in greater detail that time. And the delivery units and the trading units are matching. So, seller who has brought in and, transacted certain lots, exact amount of quantity can be delivered there. And so there will never be a residual quantity which he has to cash settle and take back. So nothing of that sort will happen. Most importantly is that, MCX is a futures exchange. So we basically charge margin for whoever wants to transact. So it's a normal way of functioning. So, if the brokers or the members of exchange are asking you to put up margin, it is very logical and very reasonable. How much is charged and all of that is freely accessible on our website. So nobody can take you for a ride to that extent. And our website is, carries host of data for your ready reference to be aware and to be enlightened about what's the broader framework under which the MCX works. Finally, the last 2 rows, the client level maximum position one can take are highlighted, but these are decent quantities. I think for anyone who wants to transact on a monthly basis, we believe these numbers are pretty good. But if there is a requirement because of the sizable order or a long-term order, but when one has, if there is a requirement for you to come and ask for a greater position, I think there are simpler procedures allowed by SEBI for us to implement, and we can allow a greater open interest to be taken by the clients. Now coming back to this delivery center, so as I had already mentioned, aluminum is Raipur primary delivery center, but what's critical also to note is that aluminum is a unique contract we have where it is east, west, north, south and center. So Thane in Maharashtra, Palwal in Haryana, which is also part of NCR, so near Delhi, Chennai and Calcutta. So all of these are part of the aluminum contract, and there is no premium discount to this, which means price at which a seller can realize at delivering at any of the locations is going to be same. We don't provide any premium or discount based on the location. But if you try to imagine how the domestic production is, so the Balco, which is Chhattisgarh unit, the Vedanta Aluminium based in Odisha, Nalco, which is based in Odisha, Aditya Aluminium, which is again based in Odisha, and bit of aluminium being produced in Renupur, Hindalco, which is at close to Varanasi. So a smaller quantity, but overall basis, if you try to imagine how the redistribution of metal happens from the production centers, is Raipur happens to be a classic redistribution location, and that's where we see great amount of deliveries being happening, and people buying from that location and taking it for their consumption from there on. So that is how, and that is why the primary delivery center is Raipur. But from a seller's point of view, or from all those who have got a residual quantity at their backyard and unused quantity, and they want to get rid of that inventory, they are all welcome to actually deliver on exchange and get reimbursed for it. While this may appear to be a very simplistic statement, but let me help you to stretch your imagination and take you back in history as recent as the start of the pandemic. Try to imagine as to how life suddenly came to a grinding halt in April and May 2020, when the pandemic and the lockdowns were announced. So try to imagine that all those who had inventory which was work in progress, which was on high seas coming to this thing, and you as you committed to the producers, and producers had already dispatched, all that inventory was suddenly pain because you couldn't do anything. And at that point in time, the amount of deliveries which were done or people delivered, so there is no reason that one has to be a trader or importer or a producer. As long as you have LME registered brand of metal or MCX registered brand of lead, you can very well deliver on exchange and get reimbursed for it, and you can deliver on any of the locations. So for aluminium, these are the 5 locations. For copper, we have presence in 4, which is east, west, north, south, Thane, Palwal, Chennai, Calcutta. Same is the case with lead, same is the case with nickel. On zinc, we are currently at 2 locations, which is west and east. So it is Thane and Calcutta, and we are hoping that we will add north and south in due course. But the purpose of showing this is that our presence is now pan-India. We display constantly everyday basis as to where the inventories are lying, in which shape and how much quantity, so that people are aware that in case eventually if you end up taking delivery on MCX, where is the likely location from where you will take it, and based on that you can decide whether to roll over or actually take the delivery from there or exit the position. So this is about the delivery centers. Now, when I started, I was clearly intending that my purpose was that people go back with a clear message that one can hedge and can, because this is the volatility chart. I mean right from the financial year 2015-16, imagine about about 7 years, 8 years back, there were always reasons why the prices were likely to go up, and there were always reasons as to why the prices were likely to go down. But we have all sailed through these troubled times, and the ambition always remained that we wanted to be, making profits, and the margin need to be intact. And in some way or the other, this was very much done. I mean, which is what the classic, this thing. But the issue is in terms of profitability, or to ensure that the the losses are minimized. Was there a way? I mean, try to imagine, were there trouble times in these days? And you look at the volatility numbers, what we have. I mean, aluminium per se, which used to be, everybody thought that is the least doesn't move at all. I mean, we have taken, aluminium for that reason. I mean, it was 2015, 16 was 18%, 16, 17, 14%, but look at the numbers and the growth thereafter. So 2018, 19 was 28% volatility, 27% volatility. And I think this year in 2021, 22 was as much. I haven't provided the details for the current financial year, but I leave it to your good imagination as to what's going to happen, because I think none of them are holding steady, whether it goes up, goes down, whether rupee is depreciating, whether the news of war is coming, whether to focus on demand, whether to supply constraints are challenges. Sometimes the ship will, in the Suez Canal will get stuck and the supply chains will go in disarray. Sometimes Chinese are stopping, either purchases or sales, and so endlessly we can keep guessing as to what is happening. Other way around is, the advantage is, why not look at a mechanism like MCX and hedge ourselves? So this is again repeating what I'm saying, that, either do nothing, keep hoping that everything will work in your favor, versus take control of things, hedge yourself. And I mean, let me tell you very, very clearly that when we say the hedge yourself, we also want you to be aware that it's not a one-way traffic. I mean, there are times when the prices actually went in your favor and you would have made more money, and there are times when the prices went in your against your, and you would have lost money. But that will get evened out. So when you hedge, cash outflows, inflows or outflows may happen because of hedging activity, but overall on the balance sheet you will find a neutralized thing, and your original estimates on margin will remain intact, provided you look at, and it's a discipline. So at the end of the day, you have to choose to start, make a small beginning and ramp it up to the level where, this becomes a very excellent tool for you to ensure that the productivity goes up, the order book remains strong, and on a perpetual basis, you can think of how to keep the margin intact. Now, this is a usual bit for us to say that, frankly speaking, in our assessment, the host of people we meet, all throughout the year, there are two types of people who either have the order in hand already, and that they have to produce and supply subsequently. So which means, practically speaking, you sold first and you're going to buy later, your raw material. And the other side would be that you already have bought, converted, given it to your distributor. Now it is lying with the retailer, and someday, the person will come and buy, and some off-the-shelf product. Now, in the off-the-shelf, you are constantly buying and you don't know when the selling will happen. And in a tender-based business is where you have already sold, and progressively you will keep buying your raw material as and when needed. So, I mean, the third possibility is you do job work. So basically, the price risk is not yours. Then whoever is, either he takes the price risk in his books, or else he says, "Bhai, this is the raw material. Convert this thing into, you charge me per unit price and give it back to me." So there is no risk. But in any of the other two, which is primarily, I'm sure you are either on the right side or the left side of it, you have to think of it. And this example is where what you have said is that, the ABC company imports 10 ton of metal. Now this number may look pathetically less, but the idea is not whether you are a small consumer or a big consumer. It is not about being small or a big. It is about, even if it is small, even if it is big, the margin percentage is unique to every business. So if you are actually taking a price view, or you're letting the price view influence your margins, you are taking the impact on that percentage, which is part and parcel of you regardless of your size. So 10 tons of metal, conduct routine production, finished goods, to be sold in the physical market, put forward following. So how do you lock your routine production? So you have bought the raw material and the prevailing price was 230 rupees. God only knows when you will set. So we have assumed that, you bought on 1st June and you're going to, now that it is history, so we say that on 30th June you sold. Between 1st June and 30th June, now I don't know whether the prices went up or went down, but think both ways. I mean, what can happen? So one thing is, moment you bought, you should go, moment you bought at 230, you should correspondingly go and sell the futures. And we have taken this assumption. Now, there are two scenarios which can happen. On 30th June, either the prices have gone down like this one, or the prices have gone up like the other one. And in each of the cases, what would happen? Either you will lose 5 rupees or you will gain 5 rupees. But that loss and gain actually can be offsetted if you have a position on MCX. And that's the real message in simplistic terms we want to give, that I think it's important that we stop guessing what will happen to the price tomorrow. Take the control on margins by logging into the hedging mechanism. So this was a routine thing where perpetually you keep buying first and sell later. This was that example. And this is the anapai of it, that how it works in the other way around. So here the company has got an order in place. So now the order is logged at certain price. So prevailing price is already logged in from the sale point of view. Now to produce that end product, your raw material is going to price, to buy in the subsequent months, subsequent days. And here we have taken example that physical market, you go and buy something which was immediate, you buy on 10 June. So there is no price difference. But thereafter, the 4 examples, if you see 17 June, 24 June, 1st July, 8th July, we have assumed that the prices either have gone up or gone down. And something or other will happen. So either you will be losing money or you will be gaining money because of the change in the raw material price when you have gone out in the market to procure in the subsequent month. But effectively, the last column shows that if you have a hedge leg on an MCX, whether the prices go up, whether the prices go down, the activity on MCX or the cash flows on MCX will ensure that the effective price continues to be what you have originally estimated your budgeting, or you budgeted your numbers, and that would happen. And frankly, I mean, it's harmless. For when you work in any of the market for so long, there is by default way in which you have a price, view on the market, which is quite fine. But to disconnect from the price view and religiously, probably practice this will actually ensure that you remain, profitable, and the margins remain intact in all times to come. And that's what the idea with which we would like you to, go back and probably on the drawing board and look at. If you have any issues, you can connect with us, give us, probably specific cases, and we can help you out with our assessment as to how this will help. But broadly speaking, the other way to say whether you're buying first or selling later, importers who have risk of price falling, because you price your metal and the shipment is going to take some time. From shipment, it will take some time to reach your godowns, and from your godowns, you're going to sell. In the time duration, the prices will go down. Prices may swing. I mean, whether it goes up, goes down, doesn't matter. But that is the reason why importers need to look at MCX. Exporters have a risk because the prices may rise, raw material. So if you have an order already in place for the exports, when you go out in the market to procure raw materials, the prices go up or go down or whatever, the swing may happen. And the processors, where if it is job work, there is no price risk. But the other two, importer, exporter, nature of any business, you have challenges, and we believe that there is scope for you to do something. This is another way to help you relate to the MCX price. Whoever we speak to are so conversant with the LME price and the premium is this much and the rupee dollar is this much, and that's how. My point is that if you look at MCX, you get to see this last row. So I mean, this is hypothetical number. But I mean, if you look at MCX price and the aluminum number is saying 215.25, this is the reality of demand supply scenario in India at this point in time. Why to go to LME? Why to look at rupee dollar, or whether the rupee import duty is going to go up or go down, and how much? So all of that is all converging into a ready-made answer and giving to you that the reality of today is 215.25. And base your decision based on these numbers. And same is true for everything else, as mentioned. And GST of 18% is only to be given or taken on the deliverable lot. So that is not part of the screen price discovery. Screen price is all inclusive price. So you don't have to worry of conversion charges and the import duties and this, all of that is all factored. So rupee change factored, LME change factored, premium changes factored. All of that is very much part and parcel of MCX. And so it will help you if you are an importer, if you if you're an exporter, if you're a producer, if you're a consumer, every way. And we'll be happy to probably connect offline and understand and help you out to really connect you with the or make use of the MCX contracts for you to hedge. And one last bit, when we say MCX, there are a very strict do's and don'ts, what SEBI prescribes, and as a participant on the exchange, you all must be very well, should be aware that you need to trade only to registered members. So when I say registered members, in simple terms, what we call them as brokers, whoever you choose. I mean, everyone practically who is part of the equity, this thing, and the brands, all of them are also facilitating, action or access to the MCX. So work via them, and the exchange website has got host of details. I would encourage you to look at that, because the amount of data which we provide because of the transparency and the regulatory requirement is so humongous. I am very sure it will help you to decide on the activity you should undertake. KYC is which is what the form you fill. It has to be there. Mobile numbers, brokers, all of it, and ask for the contract notes and everything to be delivered to you, whether email or the SMSs or the physical copy. I mean, emails, everything is electronic nowadays. It is important, and is the reality. Point is, you must appreciate that this is mandated by SEBI. So if this is not happening, you have every right to go and ask that guy that, I require contract notes, I require updates on emails or whatever, so that it is there. And obviously, what is not appreciated and you should not do it is indicative returns, and then there are tips, whether you're going to go up, go down, do this, do that. Don't fall into all this trap. For any of these, what is practically possible amount of information, visit MCX website and you will appreciate the amount of detailing with respect to each of the contract what you have listed is very much available there. So, that's what my limited point, Chandrasekhar Saab, was that we believe that, this is bringing a lot of good on the table for all of those who are attending, and we'll be happy to probably connect offline as well in case if they require greater help on any of this, because everybody may not be actually transacting in the same grade and shape what has been listed on exchange, but we believe that, it's a very good value chain benchmark which has got listed, and we'll be happy to help them connect to their own product and how they can hedge about it. Thanks to you, Saab, and thanks to IMC for the opportunity to express ourselves.
Thank you, Chittaranjan. Absolutely comprehensive presentation. Very well spoken. All that I want to mention is that there is generally a tendency amongst producers of commodities that prices should go up. They expect always that prices should go up because they'll benefit. The consumers of commodities often expect that the prices should go down because commodities may be their raw material. Therefore, the raw material cost. But the market does not behave the way we want it to behave. Market's too big and there are far too many people. And therefore, the exchange price actually captures the thought, the combined thought of all the market participants. And therefore, it's important to watch how the exchange prices are moving, and that will give us a good indication, number one. And number two, whether you're a producer or you are a consumer, you will be facing price. And therefore, it is important to manage your price risk, lock in your profits, etc. In India, particularly, the investors, financial investors, are so comfortable in a rising market. You buy today, keep it for some time, hope and expect prices will rise. When prices rise, you sell, make money. This is fine, which is what happens in the stock market. Everybody expects the Sensex and Nifty to keep rising, etc. But the commodities are not a one-way street. If commodity prices rise, commodity prices also fall. There is no doubt at all. And therefore, we as exchanges, as an exchange, and as IMC as a training institution accredited by SEBI, I think all of us have started now to tell people that you don't have to be a player necessarily only in a rising market. You can actually make more money in a falling market, provided you have adequate product knowledge and market knowledge, and you have enough of research to take advantage. In fact, some of the top operators in even the equity markets have made more money in a falling market rather than in a rising market, because it rises slowly, whereas the fall is very steep. And if people with adequate product knowledge and market outlook are able to take a good call in a falling market, I think there's a huge fortunes are made and huge fortunes can be made. Yes, I think this is something we need to communicate. The second communication, Chittaranjan, as you rightly said, particularly I'm concerned in our country. There are probably 65 million or so SMEs across, and very large number of them have exposure to industrial metals, and they need some kind of hand-holding. They need to be kind of educated, they need to be trained, and they need to create awareness amongst them how to hedge their price risk, because even a small change in their raw material prices or a finished product prices can actually have a significant impact on their top line and bottom line. And therefore, SMEs should become a kind of constituency for training and awareness programs on the need for hedging price risk, etc. Yes, I think I don't see any questions really, but participants are free to post their questions quickly. But before anything, I want to go back to Kunal and request him, Kunal, if you have any kind of closing comments, closing remarks that you would like to make, and after that, of course, I'll come to Chittaranjan. Kunal, any parting comments?
I think he has left. He has disconnected.
Oh God. Okay. All right. Okay. But what? Okay. All right. Doesn't matter. There is. Let me see if there are questions. Will base metal price rise in the next quarter? We don't want to discuss prices, but I think, as I mentioned, as Kunal also mentioned, there is a possibility of a correction. Okay. In the next quarter. Okay. I request you to please share the feedback. Okay. All right. Well, spot prices are decided by the value chain participant based on demand and supply. But unfortunately, there is no transparency in the way spot prices are captured. Okay. Whereas in the futures market, it's a neutral platform, it's an electronic platform, and it's a transparent platform, and therefore it is mandated that prices are disseminated almost every day, and as and when the trades take place, and therefore commodity futures are a lot more transparent than the spot market. Yes, the futures market often take the cue from the spot market. Often both spot and futures feed on each other, and both the domestic and from a global perspective. And then therefore there will be a relationship all the time between spot and futures. Usually futures will be spot price plus cost of carry. That's the usual thumb rule, if I may mention. That's the relationship. But I'm sure Chittaranjan has something more to add.
Yeah. So the question seems to be very right and pertinent, that what we discover on screen is the futures price, very absolutely, but there is a spot price which we I would say procure or we poll on an everyday basis, from the market participant. For the commodity which is listed, so for example, aluminium ingots X Raipur is the price exchange polls every day, and we disseminate to the market for their reference, and that's a normal thing. So we not only do it for aluminium, so we do it X Chennai for lead ingots, we do X Thane for zinc ingots, we do X Thane for cathodes copper and cathodes nickel. So, and that price is also freely available on our website. So I mean, we cannot trade on spot per se, but you can trade or transact on futures price, and towards the maturity this converges with the spot price. That's the theme, or that's the idea one will have to imagine. The convergence happens towards the maturity or the expiry in the last 5 days when the delivery settlement happens. So that is but what is important, that twice a day at morning around day between around 12:30 and in the evening about 4:30, we do price polling for each of the metals, and it is disseminated on our website and our trader workstations for ready reference for the audience. And that is independent of what price discovery is happening on screen, but the convergence definitely happen at the toward the expiry. That just wanted to add that.
Very. Thank you. I think this explanation was quite important and pertinent. I think we are actually coming close to the conclusion of this webinar. After all, we can go on for even longer time, but all good things have to come to an end at some stage. Chittaranjan, thank you very much for being a part of this panel. Of course, I must thank Kunal in absentia. And any questions from the participants? Chittaranjan, please post your email ID here, so that participants can raise any question to you. Anita, you also post your email ID here, before they can write to IMC. We'll try and respond. We'll try and respond to these questions. Both IMC and MCX will continue with this awareness, education, and training program on commodities from time to time. We at IMC will keep all the participants informed as and when these events are organized. Be a part of it. And as you gain greater product knowledge and market knowledge, it will become much easier for participants to start trading on the MCX platform, whether it is energy product or precious metals, base metals, and select agriculture commodities, etc. So with this, let me thank all the participants. I also want to thank the IMC team, IT team of IMC, and of course Anita Naik, who's been coordinating all these efforts. Let me say good luck, God bless you all, take care until we meet next time, which I'm sure will be quite soon. Thank you very much.
Thank you, sir. Thanks a lot. Thanks, IMC.